drinking a German beer with a Cuban cigar in the middle of Paris with a Dominican bar. Great head on her shoulder, she probably studied abroad. She transferred to Harvard from King's College in March. She says that I'm her favorite cause she admires the art. Michelangelo with the flow, Picasso with the bar. She's well put together like a piece by Gershwin, Renaissance style. Tonight is picture perfect, so smile and pack your bags real good, baby, cause you'll be gone for a while. Girl, tell me how you feel. What's your fantasy? I see it's on the beach down in Mexico. You can put your feet up, be my senorita. We ain't gotta rush, just take it slow. You'll be in the highlight, soaking up the sunlight. Anything you want, it's yours. I have you living life like you should. You say you never had it so good.
Hi, I'm Adil Rajabali, and welcome to the Weekly Trader Show. And today we're going to talk about telecommunications sector. And I chose three companies. I chose AT&T, Sprint, Nextel, and Verizon. The reason I chose these companies because it's proven that they're the leading telecommunications companies in their industry. So the first one I'm talking about is AT&T. As everybody knows, AT&T has been here for the longest compared to other companies that we're going to talk about, or maybe Sprint is. The 2011 year, the reason I have a laptop because there's a lot of numbers and I can't memorize them, so I better look at them. So AT&T has a very strong operating revenue. People will be confused that operating revenue is the total revenue. No, it's not. Operating revenue is that revenue they're getting from that product they're actually known for or they're selling. There's actually another revenue called non-operating revenue, and that money comes from investments, financial vehicles and stuff like that. And a lot of companies these days try to get the extra leverage by having a risk management sector, and they do with stocks and stuff like that. So you'll see that a lot. It will be very common with banks and stuff like that. As for AT&T, they have strong operating revenue. It's really good. It's around $200 billion a year. That's not bad. But the thing is, they have high expenses. And I looked into it, and their high expenses, one of them that they're getting the biggest hurt on is the impairment of goodwill. Now, impairment of goodwill is when a company buys another company. It's called a goodwill. But over the years, if that other company that they bought is working undervalued than the company that they bought it for, is called impairment of goodwill. I meant. So this includes the impairment of goodwill, decreased operating income. That's after operating revenue, operating expense. It gives you operating income. It decreased by $1.7 billion compared to 2010. That's a lot of money, especially that kind of decrease in operating income. So I looked into it, and I looked into their segment statements that are when a company buys another company or like a conglomerate, they have these segments of every detailed company that they have. So I looked into it, and it was actually Singular that was actually underperforming, and it was one of the reasons for the declines. And the way I concluded that is that they were saying that Singular was the trade name or the impairment goodwill that was giving them the problems, stuff like that. They're also planning on, AT&T is also planning on adding more expenses this year, and that's going to be very difficult for their operating income to actually increase from that $1.7 billion loss that they had. So I can see seeing AT&T actually being steadfast, or they could probably be increasing just a little bit, but not that much. But as for now, they're planning on adding more expenses. They haven't actually told me what exactly were they. So I don't know if they were good expenses, bad expenses, or anything like that. So they said that's going to put pressure on the operating margin, so you have to look towards that. Now another thing that they have is their employment. 120,000 employees are having their contracts expire. 80,000 of them will immediately stop working if the contracts aren't renewed. Now, when I was reading this, I thought to myself, okay, what if AT&T decided to have a layoff or anything of that sort, and they can do layoffs at the end of their contracts rather than between them, so it'll be less expensive. That could probably happen, probably not. They haven't made those plans clear, so I don't know if they have any plans of doing that. But that gives me an idea of what if they do that, and that's going to really hurt their shares a lot. So that's another thing you have to look towards. Sprint Nextel. Their revenue and income is slowly increasing, but for the past few years they were in huge debts, and they only have an operating loss. That they just came out of the operating loss with just an operating income of 108 million. Now, 108 million sounds a lot, but compared to other companies that we're going to talk about, they have at least over $2-3 billion of income every year. So yeah, I mean, Sprint just came out from the loss, and also their stocks plummeted $5 a share in 2011. And in 2012, in the beginning of the year, their stocks even dropped to $2. Now you're talking about penny stocks now. And that's very weird because all the other companies were actually skyrocketing at the beginning of the year, rather than Sprint Nextel that was actually falling to $2. So that's another red flag. Sprint Nextel has another poor cash flow. Poor cash flow as in their liabilities, equities, and assets. Their liabilities are increasing. That means they're putting more debt or more liabilities. The equity is actually decreasing. Now, the way that works is your assets grows, and like I said, they're part of your liabilities, well, part of them are equity. So the more liabilities you add, that takes that ratio of equity lower and the ratio of liability higher. So that's what's exactly happening. The equity is decreasing, the liability is increasing. So that's a very, to me, a lot more liabilities you add, but with the equity decreasing, with the revenue looking all messed up, I mean, it's kind of a bad move. Another thing I want to talk about is they have a second consecutive net loss of $1.6 billion. Now, we already talked about, okay, they had operating income, right? Like, yes, that operating income, but that operating income then has to go through taxes, they have to go to interest rates for all the loans that they picked up, they have to go through all that, and in the end they have a net income, net loss. And that's the money that they're actually getting. That's their pro-tax money, which is they lost with $1.6 billion. They lost $1.6 billion this year. And to be honest, that's one of the minimum years that I had compared to last year's, which I think they lost $2.7 billion. So that's very unstable company for me. Another company I'm going to talk about is Verizon Wireless. When I first read Verizon Wireless, it was a very organized company. It expects to deploy 4G LTE networks into all 3G networks by mid-2013. That's a very good idea because they're looking on to expanding. They know 4G is going to be the next big thing. Why not just build it out there and get the market as quick as they can? Their operating revenue in 2011 was $110.9 billion, with $12.9 billion in operating income. Now 12.9, that's higher than AT&T, and that's higher than Sprint Nextel. Operating expenses increased over $6 billion. I know I just talked about their expenses increasing. That's probably a bad time. Where are they actually putting their expenses in? We don't know. But Verizon Wireless actually stated that they're actually taking that expense and they're putting in these 4G networks. They're going to develop them. That's just wasting that much money. But I already had a notion that, okay, they're trying to expand. Reason being is that their operating revenues increasing, their operating income is increasing, all the numbers are increasing, and their expenses are increasing as well. Whenever that happens, that's a sign that the company is actually expanding, or they're not making any loss. The expenses, they're actually expanding. It shows very strong cash flow as in steady increase in equity and assets, and very little increase in liabilities. So that's a very good thing to look for in a company. So my conclusion is that Verizon has a very strong cash flow and financial performance for the past 2 years comparing to AT&T and Sprint Nextel. I have some of these ratios I'm going to talk to you about that, like ROA for AT&T was 0.034, Sprint was 0.002, the worst out of 3 of them, and Verizon was 0.044, the best of them. That just shows that how much do they get back for their assets, how well do they use their assets, that's our ROA. Now how well do they use their equity out of those assets? AT&T has 0.04, in the middle 0.009 Sprint has that, and that's worst out of the 3 companies, and Verizon is 0.119, and that's very strong if a company has a good ROA, ROE compared to its competitors, so that's very interesting. Price to earnings ratio. Now, what price to earnings ratio actually tells you is how risky. The higher the price to earnings ratio is, that's more volatile and more risky the company is. The less the price to earnings ratio is, the less volatile, less risky, but more of an advantage. Even if it's in the same industry, is more of an advantage to invest in. That's what a price to earnings ratio tells you. Now, in this one, AT&T and Sprint had tied up at 48.54, and Verizon has 44.71. Now, like I talked about the first episode, you can't just look at the price to earnings and say if the company is good, because we just talked about that Sprint was in debt, and AT&T is putting all these expenses this year and having all these things that are going on, and Verizon is actually the one that's actually increasing. And you can see here their price to earnings is lower compared to AT&T and Sprint. So that actually doesn't the reason that happens is that it doesn't. Price to earnings does not take the overall financial structure of the company. So yeah. The forward earnings tells you that what's the company likely to increase in the market. Forward earnings for AT&T was 13.11, which is their highest. Sprint is 3.8, which is highly unlikely because it's $2. And Verizon is 9.9 between those two companies. Their market value per share. What is the market value at their shares? AT&T is $33.70 a share. Sprint is $2.62 cents a share, which is very plausible. That sounds about right. And Verizon has $42 a share. That shows a very strong outlook. Book value per share. What the accountants think of the company. Now, if you notice that the market value and the book value is higher than book value, so you think, okay, probably they're overpricing the stock. That's technically not it. If the market value is higher than book value, is a completely normal thing. It's very rarely that the book value is going to be higher than market value. So it doesn't actually tell you that the stock is overvalued. The book value for AT&T is 0.035. That's what accountants say, which is very bad. Sprint is $3.81, and Verizon is $30.70, since it is better than all of them. The enterprise value. Now, I talked about enterprise value in episode 1, how the cash has to do something with it. Enterprise value is, let me just give you the formula first. This enterprise value equals debt minus cash plus market value. Now, you find market value, that figure on the website, but the reason they calculate that is that what if a company shut down today, and if you wanted to buy it, this particular figure gives you that number, like, okay, if you buy this company now, this is how much you have to pay to buy that company. So like AT&T has 197 billion, Sprint has 89 billion, but Verizon has 248 billion dollars if you want to buy that company. So that tells a lot about a company, how strong their cash flow is, how valuable they are in the competitors' list. And to me, Verizon is going to be the leading ones in a couple of years. So my conclusion is that Verizon Wireless, you should buy Verizon Wireless. If you have Sprint next to it, you should sell it, because I can see it going down and probably be bankrupt by the next 2-3 years is very likely. And AT&T, if you have AT&T, I don't know if you should sell it or not sell it, because I mean they're still leading competitors in their sector. So I'll hold on to it and see what happens in the future. So that's about it. I'm Adil Rajabali, and welcome to the Weekly Trader Show. And I'm here to make finance sense.